So again, welcome to our session on mortgages. It's a bit of a triggering title, so I'm going to read it again. The technology is here for faster mortgages. Why isn't it happening? So we'll look forward to Jason for lead the panel discussion and decipher this triggering title. All right? So welcome, please. Thank you.
All right. Is this thing on? Can you hear me? Can you hear me? How's that? Better with this? Okay. Sorry for the delay. We were solving the world's problems. So thanks very much for having me here today. Just really quick little background. Jason Cave, 25 years at FDIC. I spent a lot of time at during the great financial crisis, not like the one we're having now, the real one, if everybody remembers that back in 2008. But I've been over at FHFA now for a couple of years. I help manage the conservatorship for Fannie and Freddie and just launched our new Fintech office. So we're really excited about that. So I get a great opportunity here to really introduce these two eminently qualified panelists. So I'm going to keep my pitch down to just a couple of key points and then hand it over to Nima and Zinat. So I'm going to give you guys a couple of numbers here. 4 numbers, a date, and a website. And then I'm going to hand it over. 4949, write these down, 4949, 5,138, 10,637. Any quick guesses? 49 days. 49 days, the average cycle time for a refinance in both 2012 and 2022. So over a 10-year period, when we've had all the financial innovations, all those people out in the convention center, all those things, we haven't seen much of a budge there on the cycle times for mortgages. So that's one number. The other number, you could probably guess what that is. That's the cost to originate a mortgage. So over that same time period, that's pretty much doubled. So, and that's in a period where we've had several improvements to automated underwriting. We've got AI, ML, and OCR. So all those things, and we've seen still a doubling of the cost there. So it's something that I raise those because it's a big thing that at the FHFA we are looking at. And so the other thing is a date, July 10th to the 13th of this year. That's the date part. We are doing our first ever tech sprint. We would love to have all of you come to it in some way, shape, or form. So that's my shameless plug, where we're going to try to figure out how do we make the trends go in the right direction. How do we get some reductions in cycle times, costs, and increase access? So we're really excited about that. And the last thing is a website. So go to your Google or whatever your web browser is, put in FHFA Tech Sprint, and up will pop the way to sign up for it. It'll say register here. So try to make that as simple as possible. So that's enough shameless plugs from me. Let's get to the reason why you guys are all here today. I have with me Nima Gasari, founder of Blend, and I think we all know about Blend and all the great things that has been going on in that space in the past couple of years. And Zinat City, who is with Loan Depot and was prior to that at SoFi, as well as Capital One and RBC. So we're really lucky today to have both a producer of some of the most cutting-edge financial tech, as well as a user of it. So I think we're in for a treat. So what I'm going to do is ask you guys a question. Maybe you could also, as part of that, do a quick intro. But let me go with Nima. First question here. You know, Blend's vision is working to bring simplicity and transparency to financial services so more consumers can gain access to the world's financial resources, which is really cool. So why don't you tell us sort of what are some of the things that Blend is doing to position itself in this challenging market to help lenders achieve greater efficiencies?
Thanks, Jason. Yeah, for those who don't know, Blend, we're a software platform that's used by banks and lenders across the country. We do about 23% of the mortgages in the country through our platform and growing. And, the numbers that you mentioned earlier are kind of staggering. I hadn't heard those numbers in a while. And every time it's staggering because there's been so much innovation around access to data, consumers' financial data. There's been so much increased innovation in automation and the technology to process the data in real time, and yet we're seeing costs go up. I mean, some of the costs, frankly, is cost of sales, but there's a decent amount that's processing costs for these loans. It just continues to go up. And I think the easiest way to describe where I think this heads is, I think a lot of the processing costs are going to have to come from a lot of the innovations that we're seeing around the data that I mentioned, but actually being utilized and adopted by lenders. We do, like I said, we do about 23% of the mortgages in the country. We do more than half of the asset verifications for consumers in the country, despite being only half. So outside of Blend, we do a disproportionate amount of the market share of asset verifications in the country. And asset verifications, just making sure you have enough for your down payment, things like that. It's really hard for lenders to adopt these technologies, not because they don't want to, but because actually building this into a modern process it's nearly impossible. And there aren't modern platforms. I mean, ZNet's probably worked with every platform in the industry. Most tech companies don't want to be in mortgage, and especially right now, and mortgage is a cyclical industry. It's very complex. It's kind of run by, it's an insiders club. Like, you kind of got to know people to be in this industry in the first place. And so tech companies don't want to be in the mortgage industry, and especially now, where being a mortgage software company or a mortgage company or a fintech that focuses on the mortgage industry, it's painful. I mean, I get beat down almost every day because we're in the mortgage industry, but it's good. It's like you're helping people get homes. It's so important to find a way to do that. And, finding the ways to lower costs. Most of the reasons that people can't get homes is because of affordability reasons. Today, 73% of Americans couldn't qualify for the median home price in America, some crazy number like that. And a lot of that is there's so much cost embedded in the system, and that has to go away for us to be successful. So even though it's painful, and even though it's an industry that nobody wants to do, somebody's got to do it. And so, I'm excited to be part of that solution.
Great. So ZNet. So I hear so much about the various tools, vendors and fintechs. Like I said, you can go out here. There's hundreds of different solutions to solve every problem under the sun. But adoption remains a challenge. So, how do you work at loanDepot through this maze of solutions to ensure you're adopting the best-in-class tech stack, or build it yourself versus buy? How do you deal with some of those integration challenges and other things to make it all work and provide the digital mortgage experience that you guys are doing at loanDepot?
Yeah, it's. I'm going to echo a lot of what Nima just mentioned. I think you've probably captured all the points that I was going to make in a very articulate way. But look, I mean, like as you said, there's no shortage of technology, and you just have to walk outside a few yards and you can see the best and the brightest in thinking in this in broader financial services industry. But technology for the sake of technology is not going to drive adoption, right? And I think one point you said, Nima, is spot on, which is, it comes down to one of the things is mindset, right? And in this industry, there has traditionally been a mindset of like, this is the way we've done it for the last 20, 30 years. And, the larger you are, the harder it is to kind of, move the Titanic, because so much of it is sort of hardened. And all the advances that have been made, for example, in the front end, game-changing, like beautiful, slick experience built by the likes of Blend and others. I mean, it has been game-changing in the industry. Where a lot of originators then fall into a challenge is, how do you connect that in a seamless way, to your loan origination system or other potentially monolithic, systems that are really, hardened and baked? Because you can drive a customer in and give them an amazing experience, but your underwriting, your fulfillment, your operations, all of those processes that live on the LOS, if you can't actually drive a better fulfillment process, a more streamlined version, that's when it falls flat. And then we, hear numbers like 49 days in this day and age. I was having dinner with somebody last night. He's a tech entrepreneur, and he went through a mortgage experience with his bank, who he's been with for most of his career. He's makes a lot of good money. He is extremely good credit. And we were chatting, and the word he used to describe his experience recent was nightmare. And I think almost 9 out of 10 people I speak to who go through this talk about it as a nightmare. And he's like, this is a bank that has all my information. I'm primary banking relationship, and yet I went through 4 months of hell. And at the end of it, I was so done, I said, I don't even want this mortgage anymore. So now think about, his experience was terrible. The bank, how much cost they put into that loan to actually drive it 4 months of I don't know how many touches, and it didn't fulfill, right? And so that's just one of many examples of why this has become so hard. And back to the, at Loan Depot, but a lot of other companies, right? It's all about how you frame it. If you're gonna come to this as a way of like, okay, how do I drive cost reduction? Okay, that's an important element, and I had heard the $10,600. I think it's the highest since the MBA has been recording this data, the highest cost to produce. Is you got to reframe it. It's like, why are you doing it? And to Nima's point, you're doing it to drive. So let me back up. Home ownership is well known to be one of the best ways to create wealth, right? And yet, with the way we have our processes and the industry and all of that, we make it so hard for consumers to tap into this way to generate wealth. And I look at it, and Loan Depot and others look at it as a way of how do we change the game and update the technology and the process and the ecosystem around it to be able to drive an improvement in access, right, and affordability. So now if you can drive the cost down, imagine taking some of that and passing it back to the consumer, right, in the form of savings, which is material. And so I think we've got to reframe how we do this. And it's all about why I continue to be in the mortgage industry. It's because I really believe that there's, this is a way for us to drive that access. So why haven't we? I think gave you one of the reasons. There's a whole host of things I could go into, but I'll let you ask more questions in terms of why we haven't kind of, we're not the holy grail yet.
Well, tell us some. Yeah, I mean, it's such a, again, the adoption challenge, is, I think probably, like you said, one of the most perplexing. The tech is there, and it's one of the things, again, at our tech sprint, another shameless plug, this issue of how to really get concrete as to what the adoption challenges are so that we get everybody working on them together, and we go back and say, here's the list. Let's see what can be done the short term, medium term, long term. But as a sneak preview, give us a couple.
Do you want to go, Nima? Oh, okay. So, look, I talked about just the mindset. Nima called it the insider club, and I agree with it, right? Like you need to have a fresh perspective, balance it with people who know enough about the industry to push the frontiers and say, look, there's a different way to do this. I think the other piece is like, if tech is the engine, like data is the oil. So you can't say, look, I'm just going to put in all of these tech components, great, but what's driving it is data. So when it comes to credit data, I think it's there's nothing new. I think there's that piece is sort of kind of well established. But then there's this whole piece of like, how do I understand what your income is? And like my friend from last night's dinner, the example of like, if you don't fit the fairway, and you have certain other sources of income or things aren't exactly, in a nice, neat package, now you're going to go to the off-ramp. And, if you're self-employed, boy, if you have crypto, or if you have, if you own a condo, or if you're, if it's a trust and things like that, now you're starting to layer on so many different complexities. And again, these aren't new, right? It's just like, how do large companies come up with a way to streamline this so that you really are addressing broad swaths of the population, and you can send them down the streamlined, automated, data-driven path, and then really reserve the off-ramp for truly complex things that are so unique, right, that you can't figure out. So part of this is that, large companies that rely on, GSEs, like, the reality is like the repurchase risk is real. So when you're constantly thinking about quality, and I can't, be off by even, a few digits on how I've captured this data or the income, et cetera, that doesn't leave a lot of space for innovation. And so now what you do is even if you adopt the technology, you layer on processes that were built over decades just to give yourself the comfort that I'm doing this extra right because I don't want to be stuck with a bunch of loans that I can't sell. And then you don't allow yourself to actually then really push the boundaries. Startups, and our tech companies have less to lose. And so they're coming in with the notion of like, I've got the tech, I'm going to build it. Versus larger companies, you gotta really be comfortable around how I'm gonna take some risks because I have a lot more at stake here, reputationally, relationship-wise, all the counterparty risk, et cetera. And so it's always a discussion that I enjoy having, which is like, who's gonna get there faster? The incumbents who have the scale, the distribution, the experience, the relationships, or the startups that have none of this baggage and are more nimble, but they don't have, all of that. I mean, I don't know what the right answer is. Ideally, a company that can adopt, the combination of the two. It'll be interesting to see how we get there. But I'm going to pause. I'd love to hear Nima's thoughts on
Nima,
this.
as you dealing with some of these lenders and the challenges, what are your thoughts on that?
Well, there's definitely, to her point, there's definitely penalties for being wrong. A lot of money's changing hands. You got to do it the right way. I don't care what it is. I don't care if it's, $300,000 or $1 million. When that's done, you got to do it the right way. There's also, you got to be fair in the way you give credit to people. You can't have unfair bias in the system. And I think that can be paralyzing, right? I think it's a little paralyzing. I mean, just one anecdote, working with one of our large customers on getting soft credit pre-qualifications live or pre-approvals live. Very large lender. Pre-qualifications using soft credit pulls have been around for ages. Saves a ton of money for everyone. The credit score for the consumer isn't damaged by it. And so all that happens, and it's all good. It's being used in every other part of the industry, the financial service industry. It just takes months and months and months to get something simple like that live, which for all of you, I'm sure is just like it's almost like, of course we do it that way. That's the way we do things. And that's just not, unfortunately, it takes a lot to get these things right. You got to make sure you're not being unfairly biased against a certain population. And there's been a lot of wrist slaps over the years, and it makes people a little gun shy. That being said, I want to go back to the thing I said earlier, which is it's very painful for me at Blend, and I'm sure for everyone else here who's working the mortgage. It's very painful to get these things live and to do it. But once you do it, and I said we do 23% of the mortgages in the country. That's millions of people a year who are benefiting from all this stuff. It is really rewarding, and so that's the trade-off. I actually think it's okay for such a big, multi-trillion-dollar a year industry to move a little slower in making these changes, because when done right, it'll be massively impactful. But I do also wish it was a little faster than what we're doing today. And I actually, on the flip, I will say I guess just to put a little bit of blame on the pandemic, there's a lot of bad things that happened in the pandemic. I don't want to minimize that. But rates going down to zero and everybody being focused on just like, how do I refi every single customer to make sure they're getting benefit of those rates? It distracted people for a long time. And we hit like a 3-year pause on innovation. And now that it's a necessity to innovate to survive, I am seeing more energy than ever from our customers to innovate. I was telling him that we were working on some cool AI stuff with one customer, just because they realize that they need to find a way to serve customers in a more automated way. And the only way they're going to survive and grow market share and whatnot is through innovating. And so I'm seeing more energy now than ever. I'm a naturally very optimistic person, and so obviously I'm biased towards optimism, but I'm hopeful that this downturn in mortgage and this increase in rates is going to cause the overall ecosystem to be a lot better off than it was 5 years ago.
Oh, that's great. Well, I think we are at time, and optimism is something that is definitely going to be needed in this space. So I really,
I maybe leave you all with one sort of piece of advice, not groundbreaking, but certainly for those of you who are part of larger institutions that may not have the nimbleness and agility to kind of, make kind of large changes. One of the things that I think we are doing at Loan Depot in a very thoughtful way to drive the innovation is like, when it's hard to do it as part of your mortgage business that, again, is very set in its way, is how do you incubate, those things in adjacent businesses or areas so you can prove out the technology and track the merits of it. For example, we launched kind of a digital HELOC product last fall, separate from the mortgage business and not tethered to that infrastructure, but really trying to understand, what can we do that's unique and different and much more aligned with the long-term vision. And some of the learnings, and there's been a lot, like we didn't roll it out perfect, but some of the learnings that we've had are now porting over onto the mortgage side in a variety of ways that is actually eye-opening, for us to say, hey, if it's working here and we're doing it at a fraction of the cost and a fraction of the cycle time, certainly we can apply some principles here. So that's one way to kind of get the organization kind of recognizing. And in this environment, to Nima's point, like when you see that differential, in cost and cycle time, it naturally just drives the impetus to say, hey, we need to find a way to do this in mortgage. And then you get the wheels turning. So it's, it's certainly worked for us. And I think, I think in any company, right? Like let's prove it in a lab and incubate it and then kind of export it to the larger areas.
Well, great. Well, Zeenat and Nima, thank you very much. Thanks, everyone. Again, July 10th to 13th, beautiful time to be
Tech
in
Sprint.
D.C. Love to
FHFA
see you all
Tech
there.
Sprint.
So thanks very much.
Thanks, everyone.
Thank you.